Growth stocks can be ridiculously expensive. Sure, POET Technologies is expected to grow its sales by almost 1,000% next year, but is that worth investors paying a price of 1,700 times its revenue? At that valuation, the company could 10x its revenue as expected, and the stock would still be expensive at 44 times price to sales. Then again, we know those growth stocks can be some of your best returns. Despite shares of Nvidia always trading expensively, now at 30 times on that price to sales valuation, investors brave enough to jump in have booked a 759% return in just the last 2 years. And for value investors, cheapskates like myself, these fast-growing expensive tech stocks can be even more painful because we miss out on those big headline returns. Titans like Amazon, Google, and Netflix were always too expensive for my value screens, and I'll admit, I missed out on those best returns in these stocks. But it also does not have to mean that you should be ready to pay anything for a stock. That same strict rule on not paying too much for a stock saved my portfolio from that massive 2021 sell-off in stocks like Zoom, down 88%, DocuSign down 80%, and Twilio down 84% just in that 1 year. There is a solution though, one that's going to help you find those growth stocks that will produce triple-digit returns, but not leave you holding the bag when the bottom drops out. In fact, using this measure that I'll show you in this video, I found 5 growth stocks that are actually too cheap to ignore. I'll highlight those 5 stocks to buy and how to find the tech stocks at a reasonable price. Let's get started on our list with Shopify, ticker SHOP, but stick around and I'll show you how I found these bargain growth stocks. I recently highlighted Shopify as one of my top holdings with 700 shares and up 36% so far, but this one has further to go. Where Amazon is leading in the e-commerce market on its own website, Shopify helps businesses sell from their own sites and is a runaway leader in the market. Shopify controls 27% of the e-commerce website market, well above its next competitor, WooCommerce, at just 19% share. And that e-commerce market still has a lot of growth left, with online sales just 15% of the total retail in the US and even lower globally. It's a fraction of the $404 billion addressable market just in Shopify's core geographies, and that market leader, Shopify, is going to continue to get the lion's shares of that growth. The company does a great job of making e-commerce accessible to any business, with starter plans as low as $5 a month, and then upselling into higher volumes and features, locking users in for a 29% annualized growth in monthly recurring revenue. Shopify is expected to post 21% sales growth this year and over 20% next to $14 billion. And with e-commerce still growing at the double digits a year to continue that growth. Here, that 13.4 times price to sales valuation would normally make me hesitate on this stock, but when we adjust it for this average 21% growth, and I'll show you how to do this later in the video, adjusted, that's just 0.64 times on a price to sales to growth valuation that we can use to compare against other growth stocks. I'll share analyst price targets for each of the stocks in our list, but remember, these are 1-year targets, and these growth stocks are something you want to hold on to for that multi-year growth. Analysts covering Shopify are a little worried about that 200% run in the stock over the last 2 years, with an average price target near the current price. But this one is going to continue to surprise higher. We're just getting started with these growth stocks to buy, but it's all going to be pointless if you don't start with an investing plan right for you. That's why I created this quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing and is customized to your needs. I'll leave a link to that below in the description. It's totally free, just something I wanted to put together for all you out there in the community. So click through and get your step-by-step guide. I've seen too many investors miss out on the opportunity to make their money work for them. It's because they didn't have a plan that fit their needs. So look for that link and get your free customized plan. Back to our list with First Solar, ticker FSLR, and a growth industry struggling over the last couple of years. One of the nation's largest installers, SunPower, filed for bankruptcy this year, following more than 100 others after new net metering rules in California hit the solar industry, along with Chinese companies dumping cheap panels on the US market. Despite that weakness though, the market for solar energy is expected to grow at a 15% annual pace through 2030, and First Solar has an opportunity to grab market share. It's already the market leader with an estimated 21% of the industry revenue according to IBIS World, and a healthy backlog of 75 gigawatts extending through the next 6 years. And rather than shrinking as its competitors are doing, First Solar is growing into a market with 3 new facilities this year and next. The company is still earnings positive and importantly, has a sizable cash position of nearly $1 billion to hold it through those rough times. That backlog of projects is driving an expected 35% growth this year and 26% next, an average 30% growth rate that's one of the highest on our list. And because of that industry weakness, shares are relatively cheap here even without adjusting for that growth. At just 7 times on a price-to-sales basis and adjusting for that 30% growth in sales, this is the second cheapest stock on our list. And it's also got unanimous upside among the 23 analysts covering this stock, with even the low target above the current price, and a 17% upside to the average. But this is one that should continue to consolidate those solar market sales and go beyond that. You probably already have a good idea of what I'm looking for in these reasonably priced growth stocks from the first 2 picks, but I want to highlight it real quick here. You out there in the Bowtie Nation know this channel isn't about just dropping a list of stocks in your lap and saying, hey, go buy these. I want you to understand how to do this on your own, for you to be the better investor. And finding these cheap growth stocks starts simply enough by filtering those companies with the runaway growth, and then the ones at a great price. I'll show you with a screener here on Yahoo Finance because it's free and available to everyone, but you can do this on just about any stock screener. First, we want to find the company's growing revenue by at least 20% a year. That's an arbitrary number, but one I use for those fast-growing stocks. Now, to find the value plays in the group, Yahoo only offers this price-to-earnings to growth ratio, so we'll have to use that to start. I'll set this to those stocks with a PEG ratio of under 2 times. And that price-to-earnings to growth ratio, or the PEG ratio, it's a useful way to adjust valuation measures for growth, really for any stocks. Shares of Target look like a steal at a PE ratio of just 16 times, versus Walmart trading at a price of 41 times its earnings. But that perspective changes when you see Target is expected to see its revenue fall this year and only grow by about 3% next, while Walmart is clearly doing something better, growing sales by 14% this year and over 4% next. Using the PEG ratio, which adjusts for that growth, makes the comparison much closer. Now, I'll be using the price-to-sales valuation in our research and our list for a couple of reasons. First, some of your fast-growing tech stocks may not be earnings positive yet, so you're not going to have that price-to-earnings ratio. Also, though, more importantly, there are just so many accounting tricks and shenanigans a company can use to manipulate its earnings, make those profits look higher than it actually is. That's why I prefer to measure revenue growth and then the valuation measures using revenue, because it's just a little harder to fudge revenue growth. I'll show you how to do that next, but because 1,100 stocks is way too many to research, I'll narrow our list further by filtering for only those tech stocks with our growth and value criteria, which limits it to a more manageable 193 to start. From there, you can go into the stocks. We'll use Shopify as an example. And first, I want to make sure that the revenue growth is durable. We filtered for just that current year revenue growth, but I want to see the forecasts are for the company to keep growing at that pace. We see here that Shopify is expected to post 21% growth this year and just over 20% next for an average 21% sales growth. Then we'll go back to the statistics page, and remember, I want to use that price to sales ratio instead of the PE. Here we see that Shopify is trading for a price of 13.4 times its sales. That means investors are paying $13.42 a share for every dollar of revenue generated by the company. That's pretty expensive and over the 10 times price to sales I generally like to stay under when I'm buying stocks, but let's put this into perspective. If we adjust that 13.4, dividing it by that 21% revenue growth, then we get a price to sales to growth of just 0.63 times. Now, I like to see these under 1 times, but most of all, you can use it to compare against other growth stocks to see which are trading at the best prices. That's going to narrow your list of stocks to watch. And from there, you want to dig into those fundamentals we talk about here on the channel, like market share leadership, profitability margins, and the competitive advantage a company has that is going to keep that revenue growing. Back to our list, and shares of Insulet Corporation, ticker PODD, are already up 25% since recommending it late last year, but still have a cheap growth potential. Shares crashed as much as 55% last year when investors feared that those GLP-1 weight loss drugs would get everyone off diabetes and other weight-related medications. But with side effects being reported and the burden of a weekly shot, it's clear now that weight loss drugs like Ozempic are not the cure-all to obesity. And Insulet sells the #1 prescribed automated insulin delivery device in the United States with over 250,000 users globally. The total market for these devices is in the tens of millions, so we see in Insulet a market leader with lots of room for growth. And that's driven that 22% annual growth in sales for 5 years, and even better, while the company is growing, it's also becoming more profitable, increasing the operating margin by 7% over the period. Now, growth has slowed a little to just under 19% expected this year and next, but it is stable growth as the company expands into those new markets. The price to sales is already under 10 times as the stock rebounds from last year's sell-off. Rare value in a growth stock, but adjust this by that average 18.55% growth, and it's even cheaper at just 0.52 times price to sales to growth. Analysts are still scared though, with an average price target around the current price, but I think this one continues to surprise on not just that resilience in the auto insulin pump market, but its ability to take a bigger piece of that market for supernormal growth. I like this one back to near that high, around $300 a share. Zscaler, ticker ZS, is another stock I've highlighted on the channel a lot, and is one of my top holdings for just over 50,000 in 300 shares. Zscaler changed legacy cybersecurity from a network and firewall architecture to a zero-trust model in the cloud, and that first-mover disruption accounts for its amazing revenue growth. Sales grew by a 54% annualized rate in the 3 years through 2023. It now serves 40% of the companies in the Fortune 500 list and is a market leader across business groups. Our shares came down last month on a disappointing outlook, but the company recently announced a partnership with CrowdStrike that could solidify that leadership and the growth with it. The two are launching a new set of AI and zero-trust integrations into CrowdStrike's Falcon software to coordinate threat sharing, detection, and response. It is Zscaler's Zero Trust Exchange and CrowdStrike's Falcon software that are each company's competitive advantage in the industry, and combining them, I don't think there's another company that can beat it. Analysts expect sales growth of 20% this year and next, which was never really in doubt, but the stock dropped last month when management only affirmed that growth without upgrading it. But I'll take that 20% annual growth any day of the week, and that drop brought the shares into rare, inexpensive territory, now at 12 times on a price to sales, and 0.6 times on that adjusted growth measure. Analysts see a continued rebound to 25% higher over the next year. But again, cybersecurity is my favorite growth theme here, and Zscaler is one of the best in the group, so you want to be holding this well beyond that 1-year time frame. I'm going to highlight that next growth stock, one with the highest analyst upside on the list, but there is no better place to look for this growth than in penny stocks. If you want more of that 10x potential in stock returns, check out this video next, the 7 AI penny stocks I'm buying this year. 7 stocks that combine the growth of penny stocks with the returns of AI. Super Microcomputer, ticker SMCI, jumped to one of the biggest positions in my portfolio with 200 shares after doing my research on the company's recent sell-off. The company makes server and storage solutions, so the hardware for those data centers and the booming growth in AI. Supermicro builds servers using NVIDIA's chips to power data centers that can do more of that high-level computing run by artificial intelligence, with reports earlier this year that the company has received a major order for NVIDIA Blackwell's focused server racks. And Supermicro's competitive advantage in this huge growth theme is that flexibility it builds into its systems, the ability to swap out components within its racks, which makes for a strong advantage over other hardware makers. I highlighted the buy case in a video last week, but it comes down to a short seller report, Hindenburg Research, accusing the company of a list of issues. Hindenburg claims that most of its sales staff fired in 2020 fraud case have been rehired, along with accounting practices that inflate growth and a weakening margin trend. SMCI hasn't addressed the sales staff issue, which I'm not really as concerned about anyway. With the kind of growth the company has seen, it needs an experienced sales program and is going to hire the best. As for that weaker margin trend, we've known about this with the gross margin under pressure in each of the last 4 quarters on product mix, while operating expenses were up 38% over the last year on those investments in R&D. The company did delay its annual 10K report on August 30th to investigate this, but filed its quarterly report on September 3rd. When it comes down to it, none of these accusations are life-threatening for the company, and even if true, don't detract from its leadership in a growth industry. SMCI has a long history of growth, but also a long history of these kinds of problems, surging 405% in the 3 years to 2015, only to crash 65% over the next 3 years, then to rebound for 80 times your money in the 5 years to last March. It's the ultimate rebound stock. Folks, this is the leader in the strongest growth theme right now, that AI data center build-out, and even if the company has to revise some numbers in its reports, it's still going to see that explosive growth over the next few years. That's why I think growth of 88% this year is likely to bleed into next year and boost this 17% expected growth, with the shares selling for just 1.88 times on that price-to-sales valuation, well under where it traded in March, and extremely cheap on that kind of growth. Analysts are watching for that rebound as well, with a 40% upside just to the average price target, and nearly triple to the high target of $1,300 a share. Get an investing plan right for you. Look for the link in the description and create your personalized investing plan in just 5 minutes. Or click on the video to the right to see the 7 AI penny stocks I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.